Eli Lilly held a conference call with Wall Street analysts where they revealed critical insights about the company's performance. I'm going to share with you the big picture items that came out of that release and the things that I highlighted as things that I need to know in future times for making a decision about Eli Lilly stock. And I'll let you know what those things could mean and why it's important for Eli Lilly stock investors. So let's take a look at these details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the things that this recent sales surge has benefited Eli Lilly by is increasing the company's budget for research and development. The management team said that while the company is experiencing rapid growth, we're also increasing our R&D investment as early phase program data continues to impress us. So that's a couple of positives in there. Number one, the company's sales are increasing so significantly that it's allowing the company to increase its budget for research and development. Furthermore, the successes within the R&D department are encouraging the management team to increase the investment because they're getting such a good return on that investment. And longer term, this is one of the main reasons why you would want to invest in Eli Lilly stock. Many investors are really getting short-term focused with this company and its GLP-1 and the weight loss and diabetes treatments. But longer term, the reason you want to be invested in Eli Lilly stock is because of the company's capability to innovate in these categories. Not just what they're doing this year and next year, but what they're capable of doing in 5 years, in 10 years, in 15 years, and 20 years. That continued capability to develop new products that generate millions, if not billions, in revenue and profits for shareholders. So far this year has gone so well that the company increased what they thought they will generate in revenue and profitability. And that's always a good sign when the company says, you know what, to begin this year, we thought we were going to generate a certain amount of revenue and profit, but it turns out we're actually going to generate much more than that. And so that's a good sign for investors. And this is a good moment to point something out. You may have heard companies that always or consistently beat their guidance on the top and bottom line. And you might have the impression that it's a good sign when a company is consistently beating earnings and revenue estimates that they set for themselves. And I've been arguing that it's not really a good sign when a company does that. It's actually a sign that the company consistently downplays their expectations, sets a lower bar, and then jumps over that bar. On the same note, I don't like when management teams consistently miss their revenue and earnings per share guidance. That's a sign that they're consistently overestimating their capabilities. I don't like either side of that. I like when a company's management team accurately provides forecasts, right? And has an equal amount of hitting their forecast, an equal amount of beating their forecast versus missing their forecast. And the reason why is because if I'm evaluating a management team that's consistently setting a low bar and beating that expectations, I need to make an adjustment for those forecasts that they provide me, because otherwise I wouldn't be a prudent investor if I just take management for what they say, if they consistently set a low bar and beat that bar, right? So that means that I need to make an adjustment on my forecasts to adjust for the fact that this management team is conservative and consistently conservative. So I need to make an adjustment and I need to do extra work to figure out what that adjustment needs to be. Do I need to adjust higher 20%, 25%, 30%? And so I'm playing a guessing game there. I'm doing a lot of the effort in forecasting. So what was the whole point of management providing me that guidance, right? The whole point of management providing me that guidance is so that I can be more certain about the forecasting, about my forecasts for the company's revenue and profit and cash flow. And so if I'm having to adjust anyways, then what's the point for the management team to provide me the guidance, even if it's conservative? And on the same note, if it's too optimistic, right? Tesla, I provide as an example of a company that's consistently overly optimistic. right? With their product forecast and revenue and profit, everything, right? They're always over promising and under delivering. So I need to make an adjustment lower on all of those forecasts. What are those adjustments, right? So I'm still playing that guessing game, trying to forecast and do all of that effort and work. So what was the whole point of management providing that guidance? So that's something to keep in mind. I know a lot of investors are attracted to companies that are consistently beating their revenue and profit estimates. And I see that as a management team that consistently sets a low bar and beats those expectations. So I don't give companies plus, or I don't give them any points for consistently beating their revenue and earnings per share estimates. The company also said that they launched the 2 highest doses of Zepbound in vials in the United States, and they made progress in the second quarter and throughout the first half of 2025 to bring new manufacturing capacity online. And that's been important because for the most part, these products from Eli Lilly, especially the weight loss and diabetes treatments, have been undersupplied and demand exceeded supply. So much so that the US government allowed compounders to come in and sell these products to serve the market because Eli Lilly and Novo Nordisk didn't have enough supply to meet the growing consumer demand. And the US government thought these products to be so important that they allowed compounders to come in and sell lower priced versions because there wasn't enough capacity from Eli Lilly and Novo Nordisk. Interestingly, they also recently constructed a facility in Research Triangle Park in North Carolina. And that's important because of tariffs. The United States is increasing tariffs on its trading partners worldwide. And that puts some of these manufacturing facilities of companies like Eli Lilly that are based outside the United States. If they have those manufacturing, they need to pay a higher cost of goods to import those products. The company saying they will continue to bring more capacity online in the second half of 2025 and expect their production capabilities to increase further. So they keep ramping up manufacturing capacity because demand is so explosive for these products that they need to build up supply to meet this insatiable consumer demand. And that's great news for Eli Lilly stock investors. So this document I'm reading from is Eli Lilly's Q2 2025 earnings call with Wall Street analyst. I made this highlighted document available for my channel members. And if you're not already a channel member, you can join for less than $5 a month. You can see the link in the description for all of the benefits you get as a channel member. And these highlighted documents, which there are dozens and dozens of, are just one of the many benefits we provide to our members. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.